Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. If you're watching this video, I already know something about you, and I would assume that you've got a family that you care about deeply, and you're probably chasing goals that get bigger every single year. You may be grinding or building something right now, and the last thing you want is for some random, unexpected crisis to wipe away everything you've worked so hard to build. And if you're anything like me, you've got people that are depending on you and people that are also counting on you to show up. And that's why today's video isn't just important, it's essential. I'm going to show you how to protect your wealth, your health, and your family while building a powerful financial engine that quietly grows in the background. And no, this isn't some get-rich-quick scheme. This is a real strategy. I'm going to show you how to shield your money from taxes, penalty, market crashes, get paid if you ever get sick, injured, disabled, or worse than that. You'll be able to safely grow your money over time and turn your everyday living expenses into tax-free income. And here's the best part. It's all done with a single well-designed life insurance policy. A policy doesn't just benefit you, it also sets up your children, your grandchildren, and maybe even your great-grandchildren, depending on how you build this. This strategy doesn't require you to be rich to start. In fact, it works even if you're just starting out. So without further ado, let's get right into the video. Before we get into the numbers, I need to explain this process called the infinite banking concept. A lot of people get confused here. They think infinite banking is a product you buy, like a special type of insurance or an investment, but it's not a product whatsoever. It's a process. It's a way of taking back control of the banking function in your life. Think about it. Most of us trade time for money. We work hard for a paycheck and then we use that paycheck to pay bills, to buy things, or maybe save a little. But the money we do save, we usually put in a bank account where the bank, not us, decide how it's used. And while the bank lends out our money to make huge profits, we're lucky if we get paid a measly fraction of a percentage in interest. Infinite banking flips that script. Instead of giving up control to the bank, you create your own private banking system. You put your money into a specially designed whole life insurance policy, the machine that powers infinite banking, and that money starts growing for you every single day, guaranteed. You can borrow against it, you can use it for investments, you can pay it back on your own schedule, and the whole time, your original money keeps growing as if you never touched it. That is the key, uninterrupted compound interest. We're going to break this down step by step, and we're not going to skip the beginning years when the policy is still growing its foundation. I'm going to walk you through what it looks like for a 38-year-old man in good health who wants to start a modest contribution, and I'll show you exactly how the numbers play out. I'll also ensure that you understand why this works, how it can be done on a smaller budget, and why the early years look the way that they do. By the end of this video, you'll see that infinite banking is a concept that anyone can use, not just the wealthy. Now, I need to set one more thing straight before we break down these numbers. Yes, you can start infinite banking with a small amount of money, but the older you are when you start, the more you'll need to contribute for it to work effectively. And here is why. If you're young, let's say in your early 20s, you've got a long runway. The money you put into the policy has decades to grow, compound, and build a solid cash value base. However, if you're in your 60s, then the runway is a lot shorter. So to get the same results, you need to put more money in from the start. The general rule of thumb is this: take your age and multiply it by 10. That is the minimum monthly contribution that you should aim for. So let's say that you're 38 years old. You would need to put in around $380 per month. If you try to do that with only $280, the numbers just wouldn't work well enough to allow for a meaningful borrowing and repayment within the policy. Now, if you're thinking this process sounds like it may take a while or you won't be able to add enough money, you always have the option to, let's say, start a business or something like that to contribute more. Increasing your income is always a viable option, and that is why personal credit can be extremely important. Good personal credit is not required for you to take out a policy loan against a life insurance contract for infinite banking. However, a strong credit profile can make the overall strategy more effective and secure when you need to leverage external financing alongside your policy, like leveraging business funding to increase your income. And one platform that can help you boost or restore your credit score is going to be Rising. Rising is an all-in-one credit repair platform that gives you access to your credit reports and your scores, but it does more than just that. It shows you what the problem is and helps you actually work on it with a 90-day action plan. Now, Rising can help you dispute negative items like collections, charge-offs, and late payments. It can also give you a personalized credit game plan, score tracking, goal tracking, and of course, educational tools and guidance products like secured cards and credit builder loans. So if your credit is holding you back, Rising can help you understand exactly what's hurting your score and give you a plan to start improving it right away. Now you can access your credit report through Rising for just $1 with their 7-day trial. And once again, this is a 90-day action plan, so at least I would try it for 90 days before you see any results. There will be a link down in the description below, and there'll also be a link on screen for you to click. Now with that being said, let's move on to our case study for today. We're going to use a 38-year-old man who's starting with $380 per month. This will give us a more realistic example of what it can take to actually make the numbers work, while also showing why having strong personal credit can give you more options as you build your financial system. Now, we are going to use a hypothetical policy setup, and this is going to be cash policy A. Now, a lot of people in the past, when I made this video before, they were asking me where should they actually get their policy. Before we even go into it, I just want to say there's no way I can recommend any policy for you, because literally every life insurance policy is based on evaluation of your health. There's no way for me to do that. I'll give you some options at the end of where you can go to actually find your policies and maybe get some good recommendations, but unfortunately there is no way for me to actually make that recommendation for you. Let's give our hypothetical policy holder a name. We'll call him Mr. 38. He's a 38-year-old healthy male, and he doesn't use tobacco. His annual contribution is $4,460, which is split into monthly premiums of around $380. Now, here is an important detail. Part of that $380 is going to a term insurance rider. That's going to be about $30 per month. That rider exists to keep the policy from becoming taxable. I'll explain why that matters in a bit, but the remaining $350 a month goes directly into the whole life insurance portion. Now, I'm sure you're asking, why include the term rider at all? Well, when you're overfunding a whole life policy, which is what infinite banking is all about, you're putting in more than just the base premium so that you can build cash value much faster. But if you put in too much compared to the death benefit, the IRS considers that a modified endowment contract, or a MEC. That changes the tax treatment and ruins the advantage that we're after. The term rider increases the death benefit temporarily, which keeps the policy compliant until it has grown enough to stand on its own. So let's talk about year one, the so-called ugly year. Now, this is where most people misunderstand infinite banking. They expect the policy to give them back every dollar they put in right away, and when it doesn't, they assume that it's a bad deal. But that's not how this works. In year one, Mr. 38 puts in $4,560 total. By the end of that first year, his cash value, the amount of money that he can actually use, is just under $3,420. That's about 75% of what he contributed. Some people will see this and think, wait, I put in almost $5,000 and I only have access to $3,420? That's terrible. But if you compare that to, let's say, a 401k or an IRA, when you contribute to those, you're giving up control of 100% of your money until you're nearly 60. Mr. 38 is giving up control of only 25% for a single year, and after that, things start to get better. Also, remember that cash value is simply the equity you have in your death benefit. In this case, the death benefit starts at $108,000, and $3,420 of that is available to use right away for anything. That's no restrictions, no penalties, and no taxes when accessed properly. Now, let's talk about how the banking concept works inside the policy. This is where the magic really starts to happen. Now, when Mr. 38 will use that $3,420, he's not taking his own money out of the policy. His money stays inside, compounding and growing. Instead, he's borrowing against the death benefit from the insurance company's general fund. They charge him interest for the loan, but meanwhile, his entire cash value keeps earning dividends and interest as if he never touched it. That's exactly what banks do. They take in deposits, that's your money, they pay a small interest rate, then they loan it out at a higher rate. The spread is their profit. Now with infinite banking, you are the bank. Your premium payments are the deposits, your cash value is your capital, and when you take a loan, you're just leveraging that capital to make more money than the loan cost. Now let's fast forward to year $380 a month, and by the end of the year, his cash value grows to about $4,560. So that means he now has about $7,478.40 in cash value available. So basically, the previous $3,420 plus 89% of $4,560 or $4,058.40. When you combine that, that's how you get the $7,478.40. And more importantly, he's now keeping about 89% of what he puts in each year. In year one, he gave up control of about 25%. Now it's only around 11%, and the gap starts shrinking fast. By year three, Mr. 38 puts in another $4,560 and gets about $4,332 in new cash value. By year four, he hits break even. Every new premium dollar that he puts in shows up in cash value. And at that point, he's putting in around $4,560 and instantly having access to that $4,560 all tax-free. That is the turning point. From here on, his policy is fully capitalized. Every contribution adds directly to what he can use, and the growth continues to compound on the full balance, whether he borrows against it or not. So let's jump ahead to year number 10. By now, Mr. 38 is 48 years old. The term insurance rider that he needed in the early years has now dropped off. That happened in year 7 once the policy had enough death benefit to stay compliant on its own. Now, without the extra cost, his annual contribution dropped slightly to $4,200, but here's the exciting part. In year 10, the cash value now grows by $5,997.76. That's a net gain of $1,797.60 on his $4,200 contribution, which works out to a 42.8% return on that year's input. Remember, this is just the policy's internal growth. He could also borrow against the cash value and use it to make even more money elsewhere, stacking returns on top of returns. Now, let's put this into a practical scenario. At the end of year 1, Mr. 38 had $3,420 in cash value available. Let's say that he decided to borrow against it and pay off a personal loan that was costing him $250 per month. He sends that $3,420 to the lender, wipes out the debt, and then redirects the $250 monthly payments back into his policy loan. Over 1 year, that's $3,000 going back into his own system instead of it going to a bank. At the same time, his policy is still growing from his regular premiums. By year 2, he's got that $3,000 back in his control, plus $4,560 in new growth from his contributions. That's $7,560 available in year 2 to use for the next move. Maybe now he takes that $7,560 and he wipes out a credit card balance that's costing him $300 per month. Suddenly, between the personal loan and the credit card, he's recapturing $550 a month that used to leave his household forever. So here is the key takeaway. It's not about how much you start with. It's about consistently redirecting money you were losing to outside lenders back into your own system, while your total capital continues to compound untouched. Yes, if Mr. 38 had started with $40,000, he could have moved a lot faster, but even starting small, the results begin to snowball. The early years are about capitalization, building the foundation, and once you hit break even, every year just keeps getting better. And remember, all of this is happening inside a protected environment. Cash value inside a properly structured policy that's shielded from lawsuits and creditors. It grows tax-free, and loans are not a taxable event. That's why this strategy is so powerful. Now, I want to pause and address the biggest mental roadblocks that people hit when they think about a policy illustration like we just talked about. Starting with what happens if you never repay a loan that you borrowed against your policy. The answer is simple. The outstanding loan balance is deducted from the death benefit when you pass away. If Mr. 38 was to take out a $10,000 loan and never repays it, his death benefit is $108,000. His beneficiaries would receive $98,000. The trade-off is that in his lifetime, he had the use of that $10,000 to invest, to grow a business, or cover a major expense, while the rest of his cash value kept compounding. Most people want instant gratification. They're used to swiping credit cards today, paying it off later. They want to see dollar for dollar access from the first month. Infinite banking doesn't work like that. In the beginning, part of your premium goes towards the cost of the insurance and building long-term structure of the policy. That's why in year one, you're only seeing around 75% of your contribution available as cash value. You're building the framework that will support decades of tax-free growth and liquidity. Think of it like planting an apple tree. The first year you dig the hole, you plant the seed, you water it, and then you protect it. You don't expect to be making pies the next day, but give it time and that tree starts producing fruit every single season, far more than you could ever get if you tried to buy apples one at a time at the store. And that's the power of compounding inside the policy. I'm sure everyone watching this video knows who Albert Einstein is, and Einstein's theory of relativity fundamentally changed our understanding of space, time, gravity, and the universe. No one knows his IQ or how smart he was, which for me is irrelevant. I don't believe in like standardized testing to measure anything, but I think, he was a pretty smart guy. Now, Albert Einstein said that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And that's where infinite banking will get exciting. Once your policy is capitalized, the cash value keeps compounding on every dollar that is currently in there, whether you've borrowed against it or not. Imagine taking a policy loan to invest in something else. Maybe you buy a piece of equipment for a side business, or you use it to do a down payment on an income producing property. Your cash value inside the policy still grows because you didn't actually take money out, you borrowed against it. And if your outside investment will produce a return higher than the interest rate on the loan, you've just layered an additional profit stream. This is what I mean when I say you can stack returns. Your money is doing two jobs at once, compounding inside the policy and producing results outside of it. Even starting small, the principle is the same. The more money that you can put into the system, the faster it will grow and the sooner that you'll be able to use it for bigger opportunities. I want to thank you guys so much for watching this video. If you guys like this infinite banking concept, then let me know. I would be more than happy to make more videos on this. Last year, it didn't do so good. I'm going to see if there's any more interest now. If there is, I'll definitely make more videos. And once again, all the examples in this video were fictitious, but again, the concept itself, that's the most important part. And like I said last year, I believe that every man has two responsibilities. Number one is to protect your household, and the second one is to provide for it. You protect your family from harm, you provide them with opportunities, and most of us do this by going out and making money. Maybe you're building a business, or maybe you're working harder in your career. Either way, the information that I provide are just tools to help you do those two things. And we don't have to use every tool in our toolbox, but it's good to know what's available in case we need them. Once again, thank you so much for watching this video, and you guys have a wonderful day.